The stock price is moving in a pattern, and if you are a long-term investor with at least 2 to 3 years of horizon, then you can consider buying at the current level. If you are looking for a trading opportunity with a target of previous peak, then I think you could avoid this stock for now and wait for the better price, as this structure could continue and price may reverse from its resistance line. Hello everyone, welcome to today's video. Today we are going to discuss a company named as Galaxy Surfactants. They are the leading manufacturer of surfactants and the specialty ingredients for the home care and personal care industries. They supply their products to leading FMCG companies, and these products find applications in various skincare products, oral care, hair care and cosmetics, toiletries and household cleaning materials, etc. Be it shampoo, soap, toothpaste, shaving cream, foam, sunscreen, moisturizers, toiletries, etc. All these products just I mentioned need ingredients from the Galaxy's surfactants. As you can see, they also have a global presence, and look at their revenue breakup. They have a very balanced revenue mix, and in India they have total six. Currently, they have total 6 manufacturing plants. Let's look at their revenue, PAT, and volume growth. It's good to see that everything is in increasing trend. Over the years, they have reduced the debt significantly, and it's really good to see. And ROE is also very consistent. That means they are efficiently utilizing shareholders' money to generate profit. The ROC is also very consistent, and that tells us that company is efficiently utilizing the capital employed in the business and generating profit out of that. And these ROC numbers gives confidence to an investor that company can reinvest back into the business and to grow further, and that could fetch more profit for the shareholders in the future, because from the ROC number we can tell that company is managing its capital very efficiently, and they are putting the money on the right assets. See, both revenue and net profit are more than industry average, and also in the last 5 years they have increased their market share. More than anything else, let's look at their free cash flow. If you see, barring 2012 and every single year after that, they have been generating positive free cash flow. Free cash flow is nothing but the cash that is left with the company after deducting their capital expenditure from the operating cash flow. Capital expenditures are nothing but the investment on the plant, equipments and properties. Company can utilize this free cash flow to pay the dividends, or to repay the borrowings, or reinvest back in the business. See, from last 2 to 3 years, company is consistently spending around 100 to 150 crores on the capex. Company has been maintaining margin consistently, but in the last 2 quarters, the margins have been dented significantly. Let's see what company's justification on the margin in their recent earning call. I have highlighted the management's response here. As with the many other companies, the number one reason for the margin pressure was the commodity inflation. They use crude derivatives, namely fatty acids and fatty alcohol, and that constitute to 80% of their raw material buying. Imagine the input cost pressure on these companies. And one more thing that we need to understand here is this is a B2B company. So unlike B2C, this B2B company cannot pass on the input cost pressure to their customers or their clients as and when they want, because there are some contractual agreements and there is a process to it. Here, the management has given the clarification of their pricing mechanism with their clients that says any incremental cost in buying the raw materials that can be passed on to the clients with a lag of 1 quarter. That means if there are any inflation, commodity inflation in this quarter, they can pass on that additional cost to their clients only in the next quarter. Management foresee there will be demand for specialty care products, so they're planning to expand their capacities. And there are 2 plants, one in Tarapur and one in Gujarat, will be ready for the commissioning in next 6 to 8 months. Here they are talking about the capex. Management says they spend around 150 to 200 crores every year on the capex, and we have seen this when we discussed about free cash flow. That shows management is committed to growth and reinvestment. So overall, the corporate governance is good, the management is clean, transparent, and committed to growth. Let's go to the chart. The price is moving in a pattern and currently trading 17% below its recent peak. If you are of the long-term view with an horizon of 2 to 3 years at least, then you can start accumulating this stock at the current level, and I would recommend adding 50% of the quantity at the current price, and then wait for price to either break this channel convincingly, and at the pullback or at the retest you can add remaining quantities. The other thing that could happen is price may continue this formation, and in that case you can wait for the price to form a lower low, then you can add remaining quantities. And if you are looking for a trading opportunity with a target of previous peak, then I think you can avoid this stock for now and wait for the better price to enter, because this pattern may continue and price could reverse from the upper resistance line. If this happens, wait for the price to make a lower low. If you like the content, please press the like button and subscribe to my channel. I will see you in the next video. Thank you for watching.